Welcome to Retail Retold, the stories behind how that store landed in your neighborhood. I'm Chris Ressa, in conversation with the people and stories shaping retail and real estate. Brought to you by DLC. Welcome to Retail Retold, everyone. Today we are live from the SiriusXM Studios at the Wynn in Las Vegas. I'm excited to be here. Today I am with Adam Ifshin, CEO of DLC. Welcome to the show in Las Vegas, Adam.
Thanks, Chris. So I bought your recording studio. Well, let's be honest. I rented briefly a recording studio for you.
This place is pretty awesome. It's obviously the best studio I've ever recorded in. And it seems fitting, right? We're at the epicenter of the largest show in our industry in Las Vegas. To be able to do Retail Retold here, I'm pretty excited about that.
I have to tell you, since the day that Sirius set up shop here in the Wynn, I have obsessed about could we ever do Retail Retold here. Now, we had to get to a point where we could afford to do Retail Retold here. That's the good news. But, you know, we are at the Super Bowl of our industry, our annual Super Bowl, the deal making, the networking, the friends, the partners. And what is more fitting for your podcast to be the pregame show for the Super Bowl of retail real estate?
Couldn't have said it any better myself. With that, let's jump into what we have to talk about today. We have a lot of interesting stuff about what's going on in the space today, what's going on in DLC. But for those who don't know, and I know this is few, but for those who don't know, can you give a little bit about you, how you got into the business, how you started DLC?
Yeah, so we're going to go super quick because I do think it is pretty well-trodden ground. A lot of people in the industry know me. I've been in the industry forever because I am old.
We do have some new young listeners.
We do. Hopefully we have some new young people in the industry, which has been a mantra of mine forever. So look, I started my first business when I was 19, my college dorm room while I was a two-sport athlete in college. Sold that business when I was 22 because I didn't want to be a contractor full-time as a career. My dad had been a real estate broker. He had become a real estate developer. I went to work for him and three of his partners in the residential development business. Didn't like it very much. Went to see my father about 18 months into that and said, you know, like, you're going to have a world of hurt here. This is a dangerous business. No equity, fully levered, personally guaranteed. And then my father threw me out. And then I just decided I wouldn't leave because I thought he might need my help. And 6 months later was the start of the savings and loan crisis. And I started doing a massive workout of that business for him. His partners disappeared into the night. And then in late 1990, I got engaged to the love of my life, the woman I'm still married to and deeply in love with, my wife, Alicia. And I decided that I would hang out a shingle to do workouts for other people and founded DLC to do workouts and distress. I always wanted to be an owner, but in the beginning, it was just, could I put food on the table? And quite candidly, this is also well known. We lived on 3 for $1 pasta. We waited for pasta and canned food to go on sale in the supermarket. We got married that year. I put some crews on the street and did some contracting work, but Alicia really paid the bills in the beginning.
Got it. 2 sports. What sports did you play?
So a lot of people think they're one sport, but they're not. I was a swimmer and a water polo player in college. Division III.
Which one were you better at?
I was a much better water polo player than I was a competitive swimmer.
What position?
So I was an attacker. I was a driver. The game has changed a lot. Another conversation for another time. But basically, my role in life, because I was left-handed, was to shoot and score when most people thought that it was a righty with the ball and you were left-handed.
Is that I saw? I was just going to ask. That's like being a nasty lefty pitcher when you come out of nowhere.
Really, the best way to think about it is, and I'm not a big hockey fan, but everyone's always told me what I was, and probably 80% of the goals I scored in college were I was the guy on the goalie's left side on man. It's called man up in water polo, or the equivalent of power play in hockey, and it's all about the guy on the weak side with a gun, basically.
All right, so We're at like 1990 now. You don't own anything. You're a workout guy. How did you move from workout guy to owning property?
So I had grown up in New York City, and you walk the streets of New York as a child and as an adolescent. You go to high school, and you realize that the people in New York who really create wealth are the ones who came to either develop the buildings or own the buildings. And that's, I grew up around, and I grew up exposed to, the great families of New York real estate: Mendick, Durst, Rudin, Fisher, the Zeckendorfs, the Harry Helmsley and Larry Wynn. And I always knew that if you wanted to create real wealth, you needed to be a principal. And I always had a goal of being a principal. Now, it was a goal delayed because I had to work out this business and help my dad through what he was going through, which I never regretted for a minute. But we got an opportunity. I made a lot of relationships with a lot of the workout and distress folks for a lot of the banks and a lot of the other groups that nascently were buying up distressed debt and pools, and started to look for things to buy. And then in early 1993, I found an asset to buy, didn't have any money. Like I've said many, many times, if you're an entrepreneur who believes that it all happens the way you drew it up and you're brilliant and it's perfect every time, and your business plan, you can pull out that business plan 35 years later and it says you did exactly what it says, run away from that person, because they are not telling the truth, gang. What happened was we got lucky. Somebody we knew introduced us to a woman who had been in a multi-year litigation over a piece of property. And ultimately, that piece of property was taken by eminent domain. And she had for the time, significant sum of money to invest. And to this day, and regrettably, I asked her the question many times. She always kept her counsel, never told me the truth. She trusted us and she believed in us. And that was an incredible break. Her family and her descendants remain large partners and investors of mine to this day. We had an extraordinary run, but that's how we got the first one done.
Unbelievable. Very cool. I don't think, you say, I don't think everyone knew that story. So I'm glad you told that. I don't think everyone knew that story, especially the new people in the industry. They didn't know it. And I think it's a pretty good inspirational story. So we just released our thought leadership campaign. And this one's a little bit different. It's out there. I'll be posting it tomorrow.
Tune in early.
But the premise of this piece, this white paper thought leadership campaign, is the rent is next. And so tell me about rent right now.
Rent's going to be the central fulcrum in our industry moving forward. And the answer is the rent is too low. Rents have been growing at a rate that is a small fraction of real inflation, even adjusted, for 25 years. And after a very, very long time, the fundamentals, which we started talking about in our first white paper now 4 years ago, you and I and our research team, has really come to the fore. The fundamentals in the industry are better now than they have been at any time since I founded the company 35 years ago. And rent follows fundamentals. It is incredibly simple. It is not complicated. But when you have tenants who are paying rents in many instances that are the same or lower than they were 15, 20, 25 years ago, and those leases and those options are now terming out, replacement rents now are, in many instances, a multiple of what many tenants are paying. It was a long, hard fight, but the industry weaned itself off of the crack cocaine of new development. It took a global financial crisis and a pandemic and a supply chain, inflation-induced supply chain insanity in 21, 22, and 23. But the net result of all of that is we have not been building enough retail GLA in this nation to replace what is demolished or taken out of service or converted to wellness, fitness, medical office, apartments in now 16, 17 years. it is legitimately the last of the real wave of new development. Absent, there's always a little bit. I don't want to suggest there's zero. That's not true. But the reality is there's so little of it now, and there was so little of it in 2009, 10, 11, and every single year, all the way through this year. I remember in 2012, I went to the World Retail Summit. I was part of the ICSC Board of Trustees. I went to the World Retail Summit in Shanghai, and they're building everywhere in China. We went out to tour everywhere. Back then, someone said to me, well, how much do you build in the United States? And I said, we're building somewhere between 2 and 5% of what we built before the global financial crisis. Post-pandemic, we're building like less than 10 or 12% of what we built in 2012. There's no space. Rent follows the fact that there is no space. We have a healthy economy. The retailers are in great shape financially, and they've gotten so much better as being operators, as being merchants. They've really cleaned up their act. They've cleaned up their balance sheets. Traffic is up, and therefore rent has only one direction to go, Chris, and it's up.
For sure. I think this was the last few months to me on the inside of it is the first I've seen it like starting to crack where you can really see meaningful net effective rent growth. I think the last few years has been an occupancy game. Everyone has filled space, but the rent hasn't moved nearly as much as the construction costs have, nearly as much as sales have grown. And that's coming off of a period of time a decade where there was no rent growth in retail real estate. And so I agree. I think the rent only has one way to go now. And we're starting to see that in our portfolio and REIT earnings, and you're starting to see that.
There's no question. And it's not just, look, I think you and the team are doing a great job. Love it. Love to see it. But when I sit down with other CEOs in the industry, public or private, the story is completely consistent across the top tier, larger, high quality landlord teams, whether, again, public or private. We get a lens into what the public guys are doing, which is nice to see. But again, I think it's really moving. The reality is what we have going on in rent is like a classic short squeeze in the stock market. That's what you got.
That's an interesting take. Well, we're going to come back to some stuff on rent. Let's talk about the other big term in the industry, cap rates. What are you seeing? What are you thinking? How are you thinking about cap rates right now?
So I think you have to look at cap rates in two very distinct ways. One is inside the product type. What's the history? What's the historic trend? What's the trend now? And then more broadly in the context of all commercial real estate. So for a very, very long time, retail real estate was essentially in its very own penalty box. Everybody was focused on all of the challenges. My children used to come home to dinner from high school and say, hey, Dad, did Amazon put you out of business yet? And we fended that question off every day from everybody, including my own children. And then it was about too much supply. And then it was about retailers going bankrupt. And then it was about bad concepts. When you come past all of that, everyone in the investor communities kept looking at retail as like this poor little stepchild in the corner. And then therefore it was its own cap rates. And the handful of us who were believers as well as quality practitioners were essentially buying at a spread to what everything else was priced at. And we were buying at a spread to the cost of capital. And that was not unprofitable. We were very successful from 2011, 2012 up into the pandemic. We were very successful. The business doubled in size. We made nice money. I put my children through college. None of them have student loans, just as one example. But what's happening now is cap rates are clearly coming in as more capital is coming into the space. And the underwriting that drives capital's conviction about safety in those durability of those cash flows is getting better because there are fewer bankruptcies, watch lists are much shorter. We're right back, right? The cap rates, just like rent, are following those improved fundamentals. That said, and I think this is a place where it's really valuable to step away from inside just this one product type, right? So if cap rates come in a little bit in retail, and they've come in some and they're coming in more, and I think they will continue to compress. And I think the bulk of that compression is in front of us, not behind us, right? You can still buy quality cash flows in the power center or the shadow grocery power center space between a 7 and a 7.75 cap. How are those cash flows that different? And the rent growth is going to be a hell of a lot better than it's going to be in logistics going forward, and even in multifamily right now. And forget about office. Office gets set to its own, is already in its own penalty box. But as you look at the flows across different product types, that's where I see the most positivity for the retail real estate industry as an investment going forward. I believe that cap rates will compress more than most people think, because people are sector rotating now out of other product types into real estate, into retail real estate for the first time in 2 decades.
Okay. Seeing that too. So now we have rents moving in a positive direction. We have, this exciting cap rate time, right? And, for the industry. If you were to take a step back and go, all right, what's the next distress point that happens in our industry? What's going to be the cause of that distress point?
Of course, historic hindsight is always 2020. I'm reminded that what causes the next war is rarely what caused the last one. I think in the short run, the industry is navigating its exposure to really historic, hard to understand geopolitical risk, right? We're moving from a bipolar, bi-superpower world to a singular superpower to a multi-powered world. We have wars all over the place. Wars are always, from a historical basis, inflationary. To me, the single biggest risk to the industry remains inflation that is not well contained by the federal bank, the national federal banks around the world, starting with the U.S. Fed. But I think, the central, the ECB and the others all have a role to play. In the short run, I think the big risk is inflation that's caused by geopolitical behavior. We are a long duration asset, as is all real estate. And as a result, stability, particularly around things like interest rates, capital flows, public safety, all of those things are very important, and more so for long duration assets. We're not trading crypto here. We're not trading ETFs here. We're still making leases that with options are going to go out 30, 40, 50, 60 years. So I think that stability is important. In the short run, that's the biggest risk. In the long term, if you look at real estate cycles, both inside of retail real estate and all forms of commercial real estate, the fundamental risk is the same, which is overbuilding. And I think there we're in a really good place. We are clearly undersupplied. Even underperforming retail real estate very often sits in very good locations. So the demand for it, for adaptive reuse, to multifamily, to town center, to experiential things, to medical, is very, very strong. That will continue to take GLA out of the mix, which will leave some room, I think, for some meaningful but not overdevelopment. And I think we will be able to take some development without it sort of, killing the golden goose.
Got it. I guess the thing I think about, if you're going to be taking advantage of the rents, the cap rates, being in a good position if distress does come one day, what are the operators and companies that are going to be able to take advantage of that? What's making those good operators today?
I think what makes a great operator is the same thing. The same things that made a good operator a great operator before are exactly the same today. You have to be nimble. You have to be entrepreneurial. You have to be prepared to deploy capital in the face of some level of risk. This is not a riskless game we're playing here. This is a very real game with very real risk. But if you do not come, and we're here in Las Vegas, so I'll use the analogy, if you do not come prepared to load the crap table, then don't come to play at all. Now, that doesn't mean that you should be reckless, right? But you can't win if you don't play. And I think that's a big part of it. Look, we built a best-in-class team at DLC over a very, very long period of time. I'm very, very proud of that. That is a very, very expensive thing to have. It's doing very different things to unlock value now than it did 10 years ago. And you were on the team both times. And you basically now lead the value creation team in this cycle, right? 10 years ago, your best-in-class team helped you play defense. Maybe you had to play a little offense, but most of you played defense. And if you could buy it cheap enough, that was good enough to make really quite outsized nice returns, high teens levered returns on an IRR basis, which is what we've always shot for and what we've always achieved at DLC. Now, you still need a best-in-class team, but what it has to do is different, right? Because you can't go in and buy a 65 or 70% lease center from a life insurance company that's foreclosed or a special servicer who's foreclosed. You can't buy a note and mortgage from a commercial bank and foreclose and take the asset over and do a complete redevelopment. And in retrospect, to some degree, the straight lease-up play, which I think, quite candidly, is what DLC made its bread and butter in, what it's known for, right? It's what your reputation in the industry is built on. We've said it 100 times, it's true. We leased 140 plus big box anchor spaces in 6 years, right? We did it great. Well, guess what? There are no boxes to lease.
Sure.
So you still have to be best in class, but now you have to be best in class in a different way, and you have to adapt, and you have to evolve, and you have to innovate. Now things like, how do I get a space back early? Am I prepared to put capital to work to get a space back early because I know that I have a redevelopment to do? Can I add a grocer? Can I densify the site? We're adding solar. We're looking at other forms of power densification on our sites. We've been adding pads forever. Your LinkedIn post this week is about adding a pad on a super high volume, high traffic, super dense site. Nobody else could figure out how to do it. Our team figured out how to do it. We unlocked a ton of value. But it's different now, right? How you approach renewals is 180 degrees different than how you approach renewals 4 years ago. So it's the same, the mantra is the same, at least for me. Best team gives you the highest probability of winning. And when I'm asked to go to that crap table and put money down, I want to go with my team, our team, the best team.
Amen. So let's go to the buzzword of every industry now. It is not unique to us. It is the buzzword in every industry. I think it's the dominant conversation in most conferences for every industry, not just commercial real estate, not just retail real estate, literally every industry, and that's AI. How are you thinking about AI, and what do you think it changes?
So without trying to give away what I'm supposed to say on main stage for ICSC plus Prop Tech on Monday morning, so make sure you're there bright-eyed 9 a.m. We'll be in the LaFleur room here at Wynn. JP Suarez, the ICSC chairman, is going to interview a bunch of us, including myself and CEO of Perform Properties, the CEO of Boxer Properties. But so look, this is obviously the thing. So let's take a step back. I've lived through the fax machine being the thing. I wrote my thesis with a second reader at MIT when I was at Williams, and I used to ship him things by a dial-up modem, which I had to use in the middle of the night because it was really expensive. Email, the World Wide Web, the internet, on and on and on and on. E-commerce, mobile. And I'm not making little of it. I think of the personal computer. AI is a huge game changer. It is on a level of, to me, the personal computer, the laptop, and the mobile phone. I think it's that big. So I think that as in any situation, I'm a big disciple of the post-World War II economist Joseph Schumpeter, who believed that capitalism was messy and there's creative destruction. And AI is going to be that current disruptor, no question. So again, I think it comes down to things that I preach all the time, like leadership. right? If it's coming, you can't stop it. Companies that unleash it for offense the best will be the companies with the best leaders, not necessarily the best technologists. I know very little about AI. I will never try to tell anybody that I understand how it works. But I do know this. It is the most extraordinary potential, keyword, weapon to increase productivity and efficiency, not only in our industry, but probably in all industry in the world. Does that mean that it's going to be really easy to do and simple? Does that mean that we can go out and fire our entire research department? No. One of the things about technology is the best technologies don't actually cause, in the long run, the employment pool in a country or even in the whole globe to shrink. Quite the contrary. What happens is growth accelerates. That creates an opportunity that requires more people to access it. The single biggest determinant in whether an economy grows is the number of people in it. So given that, if we can make those people more productive over time, and there will be some winners and losers, I'm not naive, but over time, there will be more jobs and there will be more opportunity. I heard a stat while coming out, listening to someone else's podcast, on the plane, which is that, everybody believed that SaaS software, vertical market software, automation was going to absolutely shrink and decimate the accounting industry. Since 2000, the number of accountants in the United States has 10x'd.
Wow.
Why? Because there's more need and more demand because the economy has grown so much because of those technologies. So I'm an economic demographer. That's what I wrote my thesis in. I've said this many times on a lot of podcasts, probably on yours before. We don't make enough babies in this country, which means that the people who are working, right, need to be more productive and more efficient. I do not worry about having to lay people off at DLC. When my head hits the pillow, I worry about a lot of things. I do not for 1 minute worry about laying people off at DLC because of AI. It's my responsibility, your responsibility, our other working partners at DLC's responsibility to grow the business so much that AI isn't a way to cut cost. AI is a way to grow in the face of a constrained labor market.
You heard it here first, everybody.
Sorry, JP. It'll be back on Monday.
All right. That was awesome. I think that's a really good take on AI, a unique take, and a good start to this conference, which obviously is a prop tech piece this year that it hasn't had before. I want to move on to something different. Never done this. I want to do a rapid fire. Give like 20 seconds for each one. And I'm going to ask a question. You're going to say if it's real or if it's hype. All right?
Let's go. Do it.
All right. Some layups in here. Retail rents still have material room to rise.
Very real.
Large-scale new development is still years away.
Hype. No, I apologize. I need to remember the question. The answer is it's real. That means there'll be some development, though.
AI will eliminate more CRE jobs than it creates.
Totally hype.
I'm curious on this one. Cap rates and interest rates are less correlated than they used to be.
Yes, but that doesn't mean that a significant move in interest rates will not stall out the market.
Okay.
Order of magnitude matters.
Fair enough. AI will dramatically reduce the information fragmentation in CRE.
I think that's very, very real potentially, but I think it's going to take a lot of adoption to get there.
Okay. Because I asked that one because obviously that fragmented information has been how A lot of people have made it over the years.
That would include me, I think. Yeah, I mean, it certainly has the potential to do that. But even if it does that, I'm still a big believer. You gotta have the ability to make the right call about what to do with that information, right? The analytics. And then you have to have the stomach lining to believe you're right and go deploy capital.
Foreign capital will flow into U.S. retail in a major way.
That is very real. I would define major as it will be far more 12, 24, 36, 48 months from now than it is now. But that's how I define major. There's very little of it now. There's historically been a little bit, a little Canadian money, a little Israeli money. But I do think that it's going to grow on I think there's a hockey stick there. Yeah.
Owners who bought as the pandemic was ending and interest rates were super low, call that 21, 22, will largely be fine.
100% real.
Okay. Mixed use is the future.
This is going to be very, very situational. I think more often than not, it's going to be hype. It really depends on what and where rents across all those product types go. Because the thing we've learned about mixed use, and I'm not just talking about DLC, I'm just talking about the industry in general, it is so much more expensive than you think it's going to be. And with construction costs really being the elephant in the room still, I think that that's a hard one to predict.
I'll go out. I think that one's hype.
Okay.
I think that one's hype. I think the majority of consumers, I have a younger family. We don't want to do 87 things. We want to go to the grocery store and to the gym and whatnot, but not in a place where people are living, office workers are. I think there's a place for it, but I don't think it's the future.
I think the thing about mixed use that makes it, to me, a different product type than the rest of open air retail is open air retail can be quite capital efficient. It can really be quite capital efficient, particularly if you have a very, not a lot of new development, not a lot of vacancy, shorter watch lists because the debt market, the capital markets for businesses, for retailers is more disciplined. Mixed use is much more capital intensive. And I think it's very hard. Mixed use done right looks like a cross between office, hospitality, and high-end resi. And those are three places that consume capital in huge amounts.
For sure. Two left. Operating capability matters more than basis.
It's very, very hard to outrun stupid high basis. It's really, really hard to outrun it. That said, the single biggest weapon to preserve capital, right? The first thing you have to do is preserve the capital, sometimes in very difficult situations like a global financial crisis or a pandemic.
Sure.
For preserving capital, the single biggest thing is the quality of the team.
Retail real estate is still a great industry for young people to enter.
More real than anybody knows. It is an extraordinary time for young people to enter this industry. The dirty little secret is our industry has not been able to entice, recruit young people in to replace the people who are naturally aging out. So I think there's extraordinary opportunity in the industry.
Awesome. All right. Let's move on to DLC for a bit. One of the things I wondered with the success of DLC and how you think about it is, what do you think we've believed before others did?
The single best best risk mitigant you can have is low rents. Remember, we're an acquirer. We're not a developer by and large. So this comes back to your basis point. Low rents generally lead to lower basis. If you believe in the long run in your team that you can make money when you get that space back, the amount of money you make in that space, there are a number of factors, what rent you can get, what it costs you to redevelop the space. But the other big one is what's your basis in that space. We made a lot of money. We made a lot of hay with a bunch of $2 Kmarts.
Sure did.
And the reality is that I think we believe that when we were out buying and taking Kmart risk and all the other Sears risk and Service Merchandise risk and all the different names that we redeveloped the boxes into, really now tremendous traffic generators, sales generating, high credit quality retailers. Everybody else was going the other way. I remember vividly, REITs with low rents were disproportionately dinged with a lower multiple, and the REITs that had the highest average ABR, average base rent, got the highest multiples. And I counterintuitively, as a value investor, having started in distress, thought that was wrong. So I think we believed in lower rents, buying lower rents generally leads to good outcomes if you have a great team before other people did.
I love that answer. It's a good answer. I love when we go in the acquisitions meeting.
I developed you in part into who you are to take advantage of exactly that.
I love in the acquisition meeting when we get the 100,000 footer at $3 rents. In your mind's eye, recently, where do you think we've missed and where do you think we've nailed it?
I think that let's be candid and start. I think historically, I waited too long to raise institutional capital in large amounts. I had always raised some. In the last few years, I finally, said, wait a minute, this is crazy. We need to grow faster. We can grow faster. We got the best team, and we're not creating enough opportunities to put that team to work, to deploy that weapon. If you build that weapon, if you sharpen it, if you forge it in the fire, and then you keep it in the scabbard forever, what good does it do? It's just this thing that sits on your mantle, above your mantle, and you look at it, but you don't make any money with it, right? You only make money with it when you take it out and you take it into battle and you make it happen. So I think that's probably the biggest miss. The corollary to that, and I remember vividly a video call with one of our other partners, you and Jonathan, called me at the very beginning of the pandemic and said, you're not going to work on dealing with the lenders and you're not going to work on dealing with the tenants. I'm like, I'm sitting at home, like boxed in. You guys aren't going to let me do anything. And you guys are like, no, we've never played enough offense. You've never played enough offense, Adam. We don't want you to get bogged down in playing defense. Go play offense. And that was really a turning point. And we have more than doubled the size of the company since the night of that phone call.
Got it. So our platform has evolved
dramatically.
And one of the things we have now is we have a general contracting firm, Renova. We have an architecture firm, NWS. Still to this day, people are like, really interesting, but they're unsure. Why have we evolved into that?
So I've always considered myself an entrepreneur first and a team builder first and a real estate investor and a real estate owner second. I'm fascinated by the challenge of growing businesses that can make margin and hopefully industry leading margin at what they do. I looked at the landscape in, right around the pandemic basically and said, we may not be able to buy. The capital markets may not let us buy. Nobody knew what that meant for retail real estate. But we had all these relationships, many of them yours, Adam Greenberg's, Travis Farron's, mine, everybody on the team, right? John Costios, Dan Neiman's. And we had great relationships with tenants. And we had a track record of getting them in, open, and operating in our own centers, sometimes against really long odds, right? Complicated deals, old buildings, asbestos, environmental conditions. I mean, we once knocked down a regional mall, took out 1 million square feet of asbestos, relocated 6 water mains that served 17,000 homes, built a power center, made money. And I said to myself, if we're doing that for ourselves and we have these great relationships with these extraordinary clients, just awesome clients, how can we take it to them? How can we create win-win situations where we can add more value for them and we can expand and make more money? Because I didn't know how much we were going to be able to expand the underlying core business. And I wanted to keep growing. Selfishly, when we started having those conversations, I was 54, about to turn 55. It's like, it's keeping me young. And I would rather be feeling young than feeling old. So from my perspective, was it a little selfish? Maybe, yeah. But I think we're adding great value to retailers. You look at what we're doing now, and those businesses are like, we bought NWS in 2020. We started in late 21. We closed in 2023. This little, modest-sized architecture firm has now grown 60, 70% since we acquired it, and we haven't really unleashed our relationships yet. I think that business is going to add so much value for the retailers and make us money. I've always said, particularly after the tech bubble in 2000, when everyone started looking at it, when everyone thought it was a zero-sum game between the landlords and the tenants, and that sort of, hit its penultimate level, during the height of the Amazon's going to put us out of business era, which is fortunately now far back in the rearview mirror. One day, maybe Jeff Bezos will figure out how to make money, selling things to people, but we haven't seen it yet. The reality is that we have this immense opportunity. And by doing this, we can find so many more ways. I always said back then we wanted to have win-win relationships with retailers. And I believe to this day, the fact that we didn't treat it as a zero-sum game with the retailers, even in the darkest hours, is why they have been such good partners with us. We gave them a reason to be great partners with DLC, and now we're giving them more reasons. And look, I'll never forget it. Somebody really well known in the industry, now retired, George Drummy, was the head of real estate construction design facilities for TJX, legend in the industry. George and I were standing waiting outside a hotel one night to go to a dinner. We were waiting for a taxi to come to take us to a dinner. And he said to me, I hear you're starting a construction company. I said, I am, George. He goes, I think that's a really good idea. He goes, we struggle to ever find people in construction and design who we can think of as our partners the way we think of DLC as a partner, as a landlord partner. And not just us. He mentioned some other names. And that really struck me. I said, if George Drummy's telling me that while we're waiting to take a taxi together to dinner, it must really be on his mind. And that's when I said, okay, let's go do this.
I love that. So many nuggets there. I want to take us just to the end and go 10 years from now. Where do you see DLC?
I think that we will be one of the very largest, if not the largest, private owner operator of open air retail in America. I think we could be a $10 to $15 billion business. We were a $2 billion AUM business at the end of the pandemic. We're going to $4.5 billion right now AUM business. I could see us being a $10 to $15 billion AUM business. I could see Renovo being a mid-9 figure general contractor of choice for major retailers all over the country. And I definitely think NWS will be in the ID 100 as one of the 100 largest design firms, and probably inside of that in the top 20 or 25 for retail.
Let's go. If I had the mic, I would drop it.
Can we talk about the other businesses I want to get into?
Let's do it.
No, I'm not done building or buying businesses. I remain, first of all, I remain hugely convicted that the industry is entering a long-term phase with a long runway of positive growth. And I think that we can continue to add value in our relationships, right? To me, there are always three stakeholders in the business. Our team, first and foremost, our tenant partners, and our investor partners. And if we can continue to find ways where we can add value, we can make it rewarding to have a career at DLC. We can add value by getting you open on time and on budget. If you're a retailer, we can get you great locations if you're a retailer. Hopefully as much as possible in our own centers, but not exclusively. And then if we can, if we can add value by helping you do it all more efficiently and cost effectively with less labor on your books, then that's a real opportunity. And if we continue, we've had a great track record of making investment returns for our investor partners. And in particular, we've done a really great job of not losing people's money. Right? Do we always make the number we want to make? Sometimes we make more, sometimes we less. On balance, we've done a great job. Our returns have been terrific. Certainly relative to market conditions in the last decade, 15 years since we started doing institutional joint ventures, our returns have been amongst the very best. But the thing I'm most proud of is we're really, really extraordinary stewards of other people and our capital.
All right. Well, thank you everybody for tuning in. Looking forward to seeing everyone at the show over the next couple of days. If you haven't subscribed to our newsletter, Making It Pencil, please subscribe. If you haven't subscribed to Retail Retold, please subscribe to that as well.
And leave us a 5-star review, please.
Yes, Apple loves 5-star reviews. Should be a pretty epic year. There's a lot of optimism with retail and retail real estate. Looking forward to seeing everybody. And with that, thanks for tuning in, everyone.